For those of you who've been with me since the beginning, you know I started off on Robinhood. And then as time went on, I graduated to bigger and better brokerages, trying different ones like Tastyworks and TD Ameritrade and Webull and TradeStation even. I landed on TD Ameritrade for a while, but about 3 months ago, I came crawling back to Robinhood. And a lot of you guys have been asking rather fairly, what are you doing? I thought Robinhood was a place for people who fetishize burning money. What is Adam doing there? Well, I can tell you why I'm back. I'm a slut for that graph. I love being able to see my progress over time, and nobody does it quite like Robinhood. So that's one reason. Another reason is I do everything very, very slow paced, very methodical. Anything I do can be done over the course of a few days, and it wouldn't really matter when it happened. I'm not a fast swing trader. I'm not a day trader. I play towards the statistical side of trading options, and that is generally more slow paced. I enter limit buy orders well below the bid-ask spread and limit sell orders well above the bid-ask spread and wait for them to come to me. Everything's very slow, which Robinhood is very suited for. If I were doing anything faster and wanted orders like OCO, one cancels the other, or wanted to be able to cancel and replace orders quickly, I would not use Robinhood. But because I don't really need those, I don't really care. I like doing things manually. I like doing things slow, so Robinhood works for me. So that said, I'm back. I'm on Robinhood, and I think it's time we take a look under the hood and see what Adam's been up to. What's he getting his little dirty paws on, huh? Let's take a look. So like I said, I opened this account about 3 months ago, so you can see my progress so far over the course of 3 months. And let's work our way through my positions. My first one is a snap put. I'm short a snap put because I've been running the wheel strategy on Snap. If you don't know what the wheel strategy is, I highly encourage you check out the tutorial I did on it. It's one of the best option strategies in my opinion. And I've been running on margin, which is pretty sweet. And I'll explain what that means here in just a moment. But let's take a look at my trades I've done on Snap. If you've seen that video I mentioned just a second ago, this spreadsheet is going to look very familiar. This is where we enter all our credits and debits so we can see our adjusted cost basis and our running profit and loss. So I started running the wheel strategy on October 15th, which is about a month and a half ago. And so far I've collected $430 in credit. This is a pretty good return because for this put option I'm short, which has a 44.5 strike, my collateral is $4,450, and I've made $430 on top of that. So that's about a 9 to 10% return. Like I said, I've been running this strategy on margin. And when you run the strategy on margin, something really beautiful happens. Your margin doesn't necessarily get held aside as collateral. At least it doesn't count as being invested. If it were invested margin, you would have to pay interest on it. In this case, you just have to have the margin available in case you do get assigned. You have to have the margin available to buy 100 shares at the strike price, that $4,450 we were talking about. But because it doesn't become considered invested funds and you don't pay interest on it, I'm basically running the strategy for free. I have none of my own money tied up. None of it's held aside as collateral or invested or anything. And I'm collecting premium as I sell these put options. So I've basically made an infinity return, $430 on nothing. Now, some of the more astute among you out there might be thinking, well, what happens if you get assigned? Don't you have to front the cash to buy those 100 shares? Well, you could. That's totally a possibility. But for me, I'm totally comfortable owning 100 shares of Snap on margin. And I know for some people, they hear the word margin and they see like a flash of Warren Buffett's face and they get kind of sweaty. It's like a bad word. But let me just show why in this particular situation, it does not entail a whole lot of risk. So if I look on Robinhood, I can see Snap's margin requirements. It has an initial requirement of 50% and a maintenance requirement of 25%. So I have those written here. And let's say, well, I plan on getting assigned at some point. It's going to happen. And I'll have to buy $4,450 of Snap on margin. In order to do this, there's a couple things I should know. The first is my initial requirement of 50%. What this means is I have to have marginable equities or cash in my account that is equal to 50% of the amount of margin I want to use. So let's write that out here. We'll do 50% times $4,450, which is going to be $2,225. So this is the amount of money I have to have in my account as stocks or cash in order to buy $4,450 of Snap on margin. And I definitely have that. I have like $94,000 in equities in cash. So I have well above my initial requirement. The maintenance requirement is 25% of this. So let's run the numbers before I explain that really quick. If I did the math right, that's $1,112.50. And that means that if the value of your stocks or cash drops below $1,112.50, you will get a margin call and you will have to bring the balance of your equities or cash above $1,112.50. These requirements, this collateral requirements are there in case things go wrong with Snap. They want to make sure that you have the funds available to cover any losses if Snap goes down. And to make sure that you have the funds available, they have an initial requirement of stocks and cash, and they have a maintenance requirement to make sure that your stocks and cash don't drop too low such that you wouldn't be able to cover any losses if Snap also dropped. So now we can kind of see, well, there's very little risk for someone, at least with my portfolio balance in this situation, buying 100 shares of Snap on margin. Okay, I'm well above $2,225. I would have to really screw up to drop my stocks and cash below $1,112. And if I bought $4,450 of Snap and it dropped to zero, Snap dropped to zero and became delisted, and I lost all that money, well, it's not a massive portion of my portfolio. So there's very little risk involved. The only downside is I will end up paying interest on that margin I used to buy Snap with. So if I want to avoid paying interest, I could also just deposit the cash to buy those shares or liquidate some other equities into cash to buy those shares. You could also run the strategy on margin without having to buy 100 shares on margin. If you run the strategy on margin, selling a put without having the cash as collateral, and you get assigned, just make sure that you have the funds in your bank account that you could deposit into your brokerage to buy those 100 shares. Otherwise, you will end up buying them on margin, and you just have to be comfortable with that. My next position is a LEAPS option, which is a long-term equity anticipation security. It's on Boeing. It's a call option. What LEAPS means essentially is that it's very, very deep in the money and has a very, very far out expiration. This Boeing call option has a 165 strike. It's currently trading at $223 per share, so it's very deep in the money, and then expires in January of 2022. So we have quite a bit of time until expiration. The benefit of being very deep in the money is you're going to have a very, very low break even. In addition, you're going to have quite a bit of leverage. Deeper in the money options have a higher delta, which means you're going to have higher leverage, as compared to buying a single out of the money option, for example. So very, very low break even, which means that time decay affects a small percentage of the overall value of this option. And because it has such a far out expiration, we're not going to be pushed to the buzzer. We're not trying to beat the buzzer. We're going to have plenty of time to be right and guess the overall long-term trend of the underlying stock. So in general, this is simulating owning the stock because your break even's so low, theta is going to be so low, and you have a lot of time till expiration. It's simulating owning the stock, except it's going to have a lower buying power than actually owning the stock outright. And we can judge this by taking a look at Boeing's, or this call option's delta. Delta is how much the value of this option is going to increase for every $1 move in the underlying. So if Boeing goes up $1, we can take a look at a delta of 79. The value of this call option is going to increase by $79. A single share of Boeing is going to have a 0.01 delta. Okay, if Boeing goes up $1, if you have one share, you're going to make $1. So this is the equivalent of owning 79 shares of Delta. So if I bought 79 shares of Delta at the current trading price of $223.85, I would have to have a little over $17,000 of cash to buy those shares. But in this case, I have the exact same leverage of owning 79 shares of Boeing, but the cost of this was significantly less. Right now, it's almost $8,000. So for half the buying power, I get the exact same leverage. This frees up funds from Boeing, from that investment, and it allows me to invest them elsewhere. Of course, there's more risk involved because I do have an expiration. I still do have time decay, even though time decay is going to be low and expiration's far out. If I don't beat the buzzer, I'm going to lose my money. So this does entail more risk than owning the stock outright. But if you're comfortable with the risk, because owning a call option is a defined risk strategy, then it may prove preferable to spending more money on shares of the underlying stock, especially when you believe in the growth of the stock over the next year. In this case, the recovery of the stock in the next year. Those are the two positions that require the most explaining. Okay, they're a little bit in depth. My brain is already fried right now. I can feel it. Every time I think about the stuff, my brain melts, believe it or not. So the rest of these, I'm not going to go into why I bought each stock in particular right now, but I'll just let you look through them and I'll put it to my equity so you can see how much money I have invested in each one. Okay, my position with Boeing was especially good because I initially owned like 11 grand in Boeing and I made $2,000 in profit. I sold and then bought that LEAPS option. So about a third of that LEAPS option, which I bought for around $6,000 and is now $7,800, around a third of it was bought with just profits I've made already off of Boeing. So I'm really only risking $4,000 with a high probability of success due to the low break even. The rest of these stocks are for you to peruse for your enjoyment. My brain is melting out the ears, so I think it's time for me to go. Thank you guys for watching. I'll catch you guys in the next one. And can we get some hype for that vaccine gang? This boy needs to go out. Oh, all right. Peace.
Eric, what do you think of this view?